Welcome. Today, we're diving into the world of index funds. If you've ever wondered what index funds are and how they work, you're in the right place. Index funds have become incredibly popular among investors for their simplicity, low cost, and effectiveness in building wealth over time. In this video, we'll break down the basics, explore how they operate, and discuss why they might be a smart choice for your investment portfolio. Let's start by understanding what an index fund actually is before moving on to how they function in the financial markets. An index fund is a type of investment fund designed to track the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. Instead of trying to pick individual stocks or time the market, index funds aim to mirror the returns of the entire index they follow. This means when you invest in an index fund, you're essentially buying a small piece of all the companies included in that index. This approach offers broad diversification and reduces the risk associated with investing in single stocks. A market index is a collection of selected stocks or other securities that represent a particular segment of the financial market. For example, the S&P 500 includes 500 of the largest publicly traded companies in the US. Index funds use these indices as benchmarks, aiming to match their performance. By investing in an index fund, you're gaining exposure to all the companies in that index, which helps spread out your investment risk and provides a snapshot of the market's overall health. Index funds operate by pooling money from many investors to purchase all or a representative sample of the securities in a specific index. The fund manager's job is to ensure the fund's holdings closely match the index's composition. This is typically done through a process called passive management, which means the fund isn't actively buying and selling stocks to beat the market. Instead, it simply follows the index, making adjustments only when the index itself changes. One of the key features of index funds is passive management. Unlike actively managed funds, where managers try to outperform the market by picking winning stocks, index funds simply aim to replicate the performance of their chosen index. This approach typically results in lower costs and fewer trades, which can benefit investors through reduced fees and taxes. Passive management is a big reason why index funds are so popular among both beginners and experienced investors. One of the biggest advantages of index funds is diversification. By investing in an index fund, your money is spread across many different companies and sectors, reducing the impact of any single company's poor performance on your overall investment. This broad exposure helps smooth out the ups and downs of the market and can lead to more stable returns over time. Diversification is a key principle in investing, and index funds make it easy to achieve. Index funds are known for their low costs. Because they don't require active management or frequent trading, the fees associated with index funds are usually much lower than those of actively managed funds. These lower expenses mean more of your money stays invested and can grow over time. Over the long run, saving on fees can make a significant difference in your investment returns, making index funds an attractive option for cost-conscious investors. While index funds aim to match the performance of their benchmark index, there can be slight differences known as tracking error. This occurs due to factors like fund expenses, cash holdings, or slight variations in the fund's holdings compared to the index. However, reputable index funds keep tracking error to a minimum, ensuring that your returns closely follow the index over time. There are many types of index funds, each tracking different indices. Some follow broad market indices like the S&P 500, while others focus on specific sectors, regions, or asset classes. For example, you can find index funds that track technology stocks, international markets, or even bonds. This variety allows investors to tailor their portfolios to their individual goals and risk tolerance. S&P 500 index funds are among the most popular. They track the S&P 500, which includes 500 of the largest US companies. Investing in an S&P 500 index fund gives you exposure to a wide range of industries and some of the most successful businesses in the country. These funds are often recommended for long-term investors seeking steady growth and broad diversification. International index funds track indices made up of companies outside the investor's home country. These funds provide exposure to global markets, helping diversify your portfolio beyond domestic stocks. By including international index funds, you can benefit from growth opportunities in other economies and reduce the risk associated with relying solely on one country's market. Bond index funds invest in a wide range of bonds, such as government, corporate, or municipal bonds, based on a specific bond index. These funds are a great way to add stability and income to your investment portfolio. Bond index funds typically have lower risk compared to stock index funds, making them suitable for conservative investors or those looking to balance their asset allocation. Sector index funds focus on specific industries, such as technology, healthcare, or energy. By investing in a sector index fund, you can target growth in a particular area of the economy while still enjoying the diversification benefits of an index fund. These funds are ideal for investors who want to overweight certain sectors based on their market outlook or personal interests. Investing in index funds is straightforward. You can purchase them through brokerage accounts, retirement plans like 401(k), or directly from mutual fund companies. Most index funds have low minimum investment requirements, making them accessible to a wide range of investors. Once you've chosen a fund that matches your goals, you simply invest your money and let the fund do the rest. Index funds come in two main forms: mutual funds and exchange-traded funds, ETFs. Both track an index, but ETFs trade like stocks on an exchange, allowing you to buy and sell throughout the day. Mutual funds, on the other hand, are bought or sold at the end of the trading day at the fund's net asset value. Both offer similar benefits, but ETFs may provide more flexibility for active traders. When choosing an index fund, pay attention to the expense ratio. This is the annual fee charged by the fund, expressed as a percentage of your investment. Index funds generally have very low expense ratios compared to actively managed funds, which means more of your money stays invested and can grow over time. Even small differences in expense ratios can add up significantly over the years. Index funds occasionally rebalance their holdings to stay aligned with the index they track. This means buying or selling securities as the index changes, such as when companies are added or removed. Rebalancing ensures the fund continues to accurately reflect the index's performance, keeping your investment on track with your goals. Index funds are generally more tax efficient than actively managed funds. Because they trade less frequently, they generate fewer taxable capital gains. This can help investors keep more of their returns, especially in taxable accounts. Tax efficiency is one of the reasons index funds are favored by long-term investors looking to minimize their tax burden. Many index funds allow for automatic investing, where you set up regular contributions from your bank account. This strategy, known as dollar cost averaging, helps you invest consistently over time, regardless of market conditions. Automatic investing takes the guesswork out of timing the market and can help you build wealth steadily. One of the most powerful benefits of investing in index funds is compound growth. As your investments earn returns, those returns are reinvested and begin to earn their own returns. Over time, this compounding effect can significantly increase your wealth, especially if you start early and invest consistently. While index funds offer many advantages, they're not without risks. Since they track the market, index funds will go up and down with overall market movements. They don't protect against market downturns, and you can still lose money, especially in the short term. However, their broad diversification can help reduce the impact of individual company failures. Market volatility refers to the frequent ups and downs in the value of investments. Index funds, like all investments, are affected by volatility. However, because they are diversified across many companies, the impact of volatility is often less severe than with individual stocks. Staying invested through market fluctuations is key to long-term success. Index funds are designed to match, not beat, the market. This means you won't outperform the index, but you also avoid the risk of underperforming due to poor stock selection. For most investors, matching the market's returns over the long term is a solid strategy, especially when combined with low costs and broad diversification. Index funds are generally very liquid, meaning you can buy or sell your shares easily. ETFs, in particular, can be traded throughout the day on stock exchanges, while mutual fund index funds are bought and sold at the end of the trading day. This liquidity makes index funds a flexible option for investors who may need access to their money. Index funds are known for their transparency. Because they track a public index, you always know exactly what you're investing in. Fund holdings are regularly disclosed, so you can see the companies and securities that make up your investment. This openness helps investors make informed decisions and builds trust in the investment process. Index funds are accessible to almost everyone. With low minimum investments and availability through most brokerage accounts and retirement plans, they're a great choice for both beginners and experienced investors. This accessibility has helped make index funds one of the most popular investment vehicles worldwide. Historically, index funds have delivered strong returns over the long term, often outperforming most actively managed funds. This is largely due to their low costs, broad diversification, and consistent approach. While past performance doesn't guarantee future results, index funds have a solid track record of helping investors build wealth. Many renowned investors, including Warren Buffett, have praised index funds for their simplicity and effectiveness. Buffett has even recommended that most people invest in low-cost index funds rather than trying to pick individual stocks. The endorsement of such respected figures has contributed to the widespread adoption of index funds among everyday investors. Index funds are a popular choice for retirement savings. Their low costs, diversification, and long-term growth potential make them ideal for building a retirement nest egg. Many employer-sponsored retirement plans, like 401ks, offer index fund options, making it easy to include them in your retirement strategy. For those new to investing, index funds offer a simple and effective way to get started. You don't need to be an expert in stock picking or market timing. By investing in a broad market index fund, you gain instant diversification and can start building wealth with minimal effort and low fees. Experienced investors also use index funds as core holdings in their portfolios. Even if you enjoy researching individual stocks, index funds can provide a stable foundation, allowing you to take calculated risks with a portion of your investments while keeping the rest diversified and cost-effective. Financial companies create index funds by assembling a portfolio that mirrors the components of a specific index. This involves purchasing the same stocks or bonds in the same proportions as the index. The fund is then offered to investors who can buy shares and gain exposure to the entire index through a single investment. Index funds can use different methods to replicate an index. Full replication involves buying all the securities in the index, while sampling uses a representative selection to mimic the index's performance. Both methods aim to closely track the index, but sampling can be more practical for large or complex indices. Many index funds invest in dividend-paying stocks or bonds. The dividends received are either paid out to investors or automatically reinvested in the fund. Reinvesting dividends can accelerate the compounding effect, helping your investment grow even faster over time. Some of the largest and most reputable index fund providers include Vanguard, Fidelity, and BlackRock iShares. These companies offer a wide range of index funds, each with different focuses and expense ratios. Choosing a well-established provider can give you confidence in the fund's management and reliability. When selecting an index fund, consider factors like the index it tracks, the expense ratio, the fund provider's reputation, and your own investment goals. It's important to choose a fund that aligns with your risk tolerance and long-term objectives. Doing a little research up front can help you make a smart investment decision. Picking individual stocks can be risky and time-consuming. Index funds offer a simpler alternative by providing instant diversification and market-matching returns. For most investors, index funds are a more reliable way to build wealth, without the stress of constantly monitoring the market. There are some misconceptions about index funds, such as the belief that they're only for beginners or that they can't deliver strong returns. In reality, index funds are used by investors of all experience levels and have a long history of competitive performance. Understanding the facts can help you make better investment choices. Index funds can help protect your investments from inflation. As the prices of goods and services rise, the value of companies in the index often increases as well, helping your investment keep pace with inflation over time. While no investment is completely immune to inflation, index funds offer a practical way to preserve and grow your purchasing power. Some critics argue that index funds can contribute to market bubbles by driving up the prices of the largest companies. While this is a topic of debate, most experts agree that the benefits of diversification and low costs outweigh these concerns for the average investor. Staying diversified and focused on long-term goals is the best approach. Getting started with index funds is easy. Begin by opening a brokerage account or checking your retirement plan options. Research different index funds, compare their expense ratios and performance, and choose one that fits your goals. Set up automatic contributions if possible, and remember that consistency is key to long-term success. Once you've invested in an index fund, there's no need to constantly monitor the market. Periodically, review your investment to ensure it still aligns with your goals, but avoid making frequent changes based on short-term market movements. Staying patient and disciplined is the best way to achieve long-term growth. As your financial goals or risk tolerance change, you may need to adjust your portfolio. This could involve shifting between different types of index funds or changing your allocation between stocks and bonds. Making thoughtful adjustments ensures your investments continue to support your long-term objectives. Investing in index funds is a long-term strategy. Markets will have ups and downs, but staying invested and sticking to your plan is crucial for success. Resist the urge to react to short-term market noise, and remember that time in the market is more important than timing the market. To sum up, index funds are a simple, low-cost, and effective way to invest in the stock or bond market. They offer broad diversification, low fees, and a hands-off approach that appeals to both beginners and experienced investors. By understanding how index funds work and sticking to a disciplined investment plan, you can build wealth and achieve your financial goals over time. Thanks for watching, and happy investing.